Good evening and welcome to the Covered Options Online Learning Club, otherwise known as the Cool Club. Once again, I'm Paul Madison. I'll be your host for the Cool Club. If you want to contact me, you can write to me at the Cool Club discussion list, which is cool_club@bivio.com. Just a quick reminder what these sessions are. They're intended to be 30-minute sessions where we explore the thought processes associated with actual covered option trades. Most sessions will walk through one or two actual trades from the recent past, going through the logic on why we are looking at a particular option on a particular stock. We will look at both when trades are put on, and we will come back and look again at them when they are closed. Some weeks, like last week and again tonight, will be tools oriented rather than trades. Our next meeting is the fourth Wednesday in August, August 22nd, and with our schedule that kind of changes times, next week's will be at 10 o'clock. We will be off a week, the fifth Wednesday in August, and then we'll resume in September, and the schedule for September is shown here. We're continuing to build out our Cool Club homepage. The link for it is bivio.com/cool_club. Remember, you can click on the Cool Club discussion list to join the email discussion list. We've had some good talks this past week on the list. I appreciate all the input from everybody. Well, there's the discussion list. If you click on presentations, that'll take you to copies of the handouts from all the previous Cool Club sessions, as well as recordings for all the sessions. And I believe we're up to date. I think recordings for all of the sessions have been posted. If you click on resources and tools, that'll take you to the page where the covered call cool tool is. We'll be talking more about that later. And of course, at the bottom of the sheet is the live spreadsheet that shows any open trades we've talked about on Cool Club or maybe have been discussed in the discussion list. Okay, so tonight's agenda, we're going to spend a little bit of time talking about what it means to close an option. And then from there, we're going to go into the new version of the covered call cool tool. And we'll actually walk through some examples of closing different options. And then we'll wrap up tonight by talking about last week's homework assignment. So I'll go straight into closing an option. But before we do, I want to step back just a second. And we haven't really talked about what drives option pricing. And there's two main things. Oh yeah, and that other thing. One is how long the option has to expiration. In other words, the longer time an option has to expire, the more it is worth. The second is the underlying stock price. And in this case, the closer the option is to being in the money, the higher the value is. And the third component is that nefarious critter that we'll talk about, but still not tonight, Mr. Volatility, which is just another name for fear and greed. Don't worry, we will get around to talking about volatility. Next, what I want to talk about is time premium. When an option is out of the money, all of its premium is viewed as what is called time premium. And it's called that because it only has value while there is still time left to expiration. Obviously, no one would pay any money to buy an option to buy a stock out of the money after the option reached expiration. Once an option reaches expiration, the time premium is zero. So let's look at a few examples. Let's say somebody wants to make sure that they can buy your stock $1 higher than where it currently is because they think there's a chance it could go quite a bit higher. And with 5 days out, they might pay you 50 cents. But the next day the stock still has not moved, and so they aren't quite as sure about the price going up, and so they aren't going to pay you quite as much. They're only going to pay you 40 cents. And the next day, same thing, underlying stock price has kind of stayed the same, so they're even less excited, and they're only going to pay you 30 cents. Next day, 20 cents. And finally, with 1 day left, they say, well, I'd be willing to spend a dime, but only a dime because we only got a day left. And finally, with only one, we get to the end of the expiration, and the stock has still not popped. And so now our time premium is 0. The option expires worthless. Well, this is a theoretical, and this does not happen very often because this assumes that your stock price is staying relatively flat, isn't moving anywhere. And on stocks that do that, where the stock price is not moving much, I can tell you that premiums are extremely thin, if even existent. So now let's look at a more real scenario. So same starting point, 5 days left to expiration. Somebody's willing to pay us 50 cents to be able to buy my stock at $1 higher than where the current price is. Now the next day the price of the stock actually goes up a little bit, and so they're still really excited, maybe even more excited because they're still willing to pay me 50 cents even though a day has gone by. Uh-oh, by the third, the underlying stock has had bad news story that comes out and the stock price goes down by $1. So now the buyers are much less interested in buying the option, and so it drops to 10 cents. It's exactly these kinds of opportunities that I look for to buy back an option. So if I sold for 50 cents on the first day, 2 days later I can now buy back at 10 cents and pocket the 40 cents. I still own my stock, and I go about my business with, of course, a smile on my face. Now you might say, well, why not just wait 3 more days, Paul, and see if it goes out worthless, because then you wouldn't have to spend any money to buy it back. Well, that's a great question, and sometimes that is the right answer. But sometimes Mr. Market can be quite the AC/DC kind of guy, and so the next day the stock has recovered the $1 because the news was erroneous. It was a false report, and it's gone back the $1 that it dropped. And the next day the stock was kind of flat and still below our strike, so the premium does go down a little bit because even though we've corrected the news story, we're still below our strike price. But then all of a sudden on expiration day, sure enough, the stock jumps and is 50 cents above our strike, and so that option is now worth 50 cents. And it's because of these types of market swings that drive me to want to look for opportunities to buy back when I have golden opportunities like we saw on the third day. And by buying back on day 3, I have closed the option, and so actually by the last day when it has jumped, I could turn around and sell a new call for the next expiration date, so maybe another month out, because I've uncovered my stock and I'm poised to sell a call again. So this is just kind of a little example of what goes on with options. But let's get back to the rabbit. What we want to do is talk about closing an option. So we've been talking about selling to open on covered calls. Once we have done that, we need to think about what happens next, and there's one of 3 things that will happen from this point. If I leave the option open until expiration and the stock price on the expiration day is below the strike, then the option expires worthless and I get to pocket all the premium and smile, and I still have my stock. However, if on expiration day the stock price is above the strike, then my stock will be sold at the strike price, but I still get to keep the premium that I sold, and that becomes part of the sales proceeds for the stock sale. But there's one other option, and this has to be done prior to expiration. I can buy back the option to close out the position. So what does it mean to buy to close? So as we said, it is a way that we can close our option before the expiration date. we turn around and become a buyer of the same option that we sold. We would be paying a premium rather than collecting a premium. By closing the position, we retain our stock and we're no longer obligated to sell, and we get to keep the difference between what we collected when we sold open and what it costs us to buy to close. So there's a couple different approaches to determining when's a good time to buy to close. The simplest and easiest to do is when the premium drops to some target, let's say 20% of the original premium collected. I'll buy it back. So as an example, if we did a sold to open option at $1, we would want to buy it back if it reached 20 cents, or maybe even a little lower if we want to do it net of commissions. But for me, I also like to take the time component into account. So I like to look at what the APR is on the remaining premium for the time left. And if that drops below 10%, I consider that a time to buy the option back. That means if the option is going to remain on for me, I want at least a 10% or better return for the premium that's left. The cool thing is the Cool tool will do the math for you and tell you what a maximum buyback premium would be net of commissions, and it looks at both of these approaches. Now it's time to go look at the updated covered call Cool tool. In the updated tool, there's a new sheet that has been added for closing the option, and also based on a request at last week's Cool Club, we have an enhanced commissions table to handle more different brokerage house scenarios such as Options Express that was mentioned last week. The new file will take place of the old file, but it is in the exact same place on Cool Club. From the home page of the Cool Club, click on Resources and Tools. That'll bring up this page, and in the lower right-hand corner will be the Covered Call Cool tool. I would encourage you to delete your old version before you download the new version. There is no reason to keep the older sheet. Let's go play. All right, so this is the new Covered Call Cool tool. I'm on the sheet at the left-hand side that says Getting Started. We don't have to do a lot of things here. There's just a little warning that says for this to work properly, you need to make sure that you have macros enabled and external content enabled. If you don't know how to do that, you can put a question to the discussion list and mention what version of Excel you're running, and I'm sure the group will help you tell you how to do that. A reminder that this Cool tool is all about covered calls on stock. I will have a separate tool for cash secured puts on stocks, and there'll be a third one to do options on broad market indexes such as SPY and IWM. The next thing is the brokerage commission schedule. This is an area that you can modify. So the base commission would be the minimum amount that you would pay. And the example I have here is Options Express. I guess it has a couple different levels depending on how active a trader you are, but this is the starting one. So base commission of $14.95. With that $14.95, that covers 1 to 10 contracts, so you don't pay any more for the first 10. However, above 10 contracts, then you'll pay $1.50 for every contract over 10. And then there's one other box, and that's the assignment fee or stock trade cost. Some brokers don't have an assignment fee, but when you get called away, you just pay the normal trade cost for selling a stock or buying a stock. You would put that in here. Or if your broker has an assignment fee, then you'd put it in here. If we were going to change these, as an example, Fidelity would be like $7.95. And there are no contracts in the base for Fidelity, and the per contract would be 75 cents. The stock trade cost would be $7.95. So it's that easy to change. I'm going to go back to the Options Express because that happens to be our simulator as well, so that's what some of you are seeing as you're playing with the virtual trading system. Once we've finished with the brokerage commission schedule, we only have to do that once. If we save it, it now will lock in what we have for our particular broker. Then there's two places we can go to, and these are disconnected pages. So if you're looking to sell an option, to start an option, you'd go to sell to open, and that page will look just like what you were playing with last week. Or if you're looking to close an option, then you would click on go to closing the option. That brings up our third sheet, closing the option. This is a little busier sheet. There's a lot going on. But what I'm going to do is take some time and walk through some examples so that maybe it'll help you understand how it works. So you start, if there's any data in it, then the first thing you do is click the clear data. It leaves you in the inner ticker box. And the first one I'm going to start with is the covered call on Align Technology that we put on a couple weeks ago for Cool Club. So we put our ticker in, we hit enter. That will bring in the price and the company name. And now we need to have the detail about our original option. Well, the option I sold was an August 18th expiration. The strike was a $36 strike. I collected 70 cents for my premium. I did 3 contracts, and I did this on July 30th. So as we're entering data, you see stuff gets starting to populate on the right-hand side. So this number 2 is where I make a recommendation on the maximum premium I'd pay for buying back this option. So it just recaps that it is an August 18th, $36 strike, and at this particular junction, so this will change every day, but for today I would pay a max of 8 cents. Well, let's not put our premium in quite yet. Let's jump down to the next 2 boxes. I go through all 3 options. As long as the stock price is below the strike, you'll see all 3. If the stock price is above the strike, meaning that it won't expire worthless, the numbers in this will not appear for the worthless. So 3B tells you that if the option expires worthless in 3 days, I collected $195 on the open. I won't have spent anything to close it because I'm not buying it back. I will net $195, and my APR for that option was at 35%. Option 3C is if the option is exercised, and it just is a reminder of what's going to happen if your stock gets called away. What I'm going to get is the strike price, which is $36, plus the premium, and some of you are going, wait a second, that says 65 cents, and over there you said 70. Well, this premium is net of commissions. So that's what it looks like without your commissions. Minus my assignment, and this is the assignment fee put on a per share basis. And then finally I get a proceeds per share. So if I got called away on this option, I'd be selling my stock for $36.62. By the way, when I put this option on, the market price was right around $35. So if I got called away, I'm quite happy because that's actually a 6% improvement over and above where I was at the time I put the option on. We need to be happy when we sell calls that if we get called away that we just let it happen. You'll see that with some of our other examples. Now let's go back up to 3A. What if I wanted to buy to close this? Well, I go and look and see what premium is available, and I notice that the best seller out there is 10 cents. So if I put in 10 cents, first I get a little flag that says, you might not notice, but the 10 cents is actually above what is a recommended max premium. But it goes ahead and does the calculation. Our collected to open doesn't change, but it tells us we're spending $45 to close this position. and that means our net will be $150, and yet we still have a pretty decent APR. So, this is where this is only a recommended max. You may say, I like that option and I'm going to go ahead and do that. In my particular case, with 3 days left to go and we're $1.75 below the strike, I'm quite happy to let this option ride and assume that it'll probably expire worthless on Friday. So I'm not willing to spend, especially above what I view as a max premium. Okay. Guess I'd stop there before we walk through the other 3 examples and just ask Lori if we've got any questions.
The only question was about whether this works on a Mac.
At this juncture, it does not work on a Mac. That's something that we'll try to see if we can fix, but at this juncture, it doesn't work on the Mac. Saul Seinberg, I think, may be in the audience tonight, and Saul's interested in trying to figure out how to make it work on the Mac. And I've got some ideas as well. So at some juncture in the future, it may work on the Mac. Currently, it does not.
Here's another question. Does this tool allow buy to close when there are more than a few days left? It says, i.e. a current sell date. I'm not quite sure, Dan, what you're getting at. Maybe Paul knows.
Well, the answer to the first question is it doesn't matter how many days left. If we had put in here that this was a 9/22 expiration, it'll tell you right here that there's still 38 days left. I can pay as much as 31 cents for the premium now because there's a lot more time left. So it doesn't matter how many days are left. It'll work just as fine, close or far out. All right, so let's clear our data from Align Technology. Now we're going to move to everybody's favorite. We're going to look at an Apple call. So we put in Apple. This Apple call was also an 8/18. I was going to demonstrate you can also enter this as by typing the month and the day. That'll work as well. And this was a $640 call that I put on when the market was at 614. Collected $11, one contract, and the date I sold it was July 19th. All right, so again, let's look at our other boxes for a second. Current price is $631. That's below the strike, and so it might expire worthless in 3 days, in which case I will have collected a little over $1,000. I'm not spending any money to close it. My APR is 21%. If I get called away, so if Apple price jumps $10 by Friday and I got called away, then I'd be collecting $640 plus my premium net of commissions. So again, you can see where I sold for $11, but my net premium is $10.85. I'd have an assignment fee, so my proceeds would be roughly $651, which is pretty nice. That's a 6% improvement over the price the market or the price Apple was at the time I sold the option. So I'd be quite happy to sell there. But now let's go back up to 3A and look at our buy to close. So my recommended maximum premium is $2.02, and when I go look at the best seller today, I noticed it was $1.01. So I put the $1.01 in. That is below our maximum premium. It's half. And so it says I could spend $115. I'd still net almost $1,000. My APR is pretty much unchanged. And that's a lot of money to spend. But Apple can be a pretty volatile little stock, and it wouldn't surprise me to see it move $10 in 3 days. And so in this case, I probably would err on the side of actually buying back this option to close it, capturing my $1,000, and looking for my next opportunity to sell a call against Apple stock. Okay, we got a couple more to look at. So we're going to hit clear the data. Next one is Cognizant. And again, this was on August 18th. I sold a $60 call, collected $2.50. This was 2 contracts. The date sold was July 18th. So in this case, the current price is above the strike. We're almost at $64. So that's where you can see 3B does not come into effect because it does not appear that this is going to expire worthless. I mean, it could still happen, but at this juncture, we don't think that's one of the highest probability things to happen. I could be called away, and if I'm called away, I'm going to get my $60 strike plus my premium net of commissions, less an assignment fee, and my proceeds would be $62.38 per share. Now, that's almost a 10% improvement over the $57 that I was looking at when I sold this option. So again, I'd be happy to sell there. Okay, my max premium to buy back that I'd recommend is 41 cents. Well, sure enough, as you'd expect, this is a deep in the money option at this point. And if I tried to buy it back today, the best seller would be $3.90. So I collected just under $500 when I sold this option. It would cost me $800 to buy it back, and I would be losing roughly $310 on that option if I bought it back. And I will caution you that if you are doing covered options in taxable accounts, you can get yourself in trouble if you book a loss on the option to preserve a long-term gain on your stock. That's where the government takes a dim view of, they're essentially saying you're trying to take advantage of paying less taxes now and paying long-term capital gains in the future, and they won't let you do that. So I don't recommend this from a lot of situations. Primarily, I really recommend you always going into covered calls with a mindset that I'm only going to sell strikes that I'm comfortable with my stock being called away. So in this case, the recommendation I'd have is at this juncture I'd be letting my Cognizant go and I'd collect $62.38. Could I have gotten more if I didn't have the call on? Yes. But that's no different than if I had sold my stock one day and the next day it jumps $5. And most of us don't immediately run back out and buy that stock because it jumped $5, even though we could have made more on it. Well, by buying back the option, that's sort of like what you're doing, is you're just trying to reestablish the position. So I would say in this case, you don't want to be buying back, you just let your stock go. Let's go to the next one real quickly, and that's Whirlpool. Once again, on 8/18 expiration, the strike was $67.50. The premium on the sell was $1.35. 2 contracts. It was put on July 17th. When I put this on, the market was around $61 for Whirlpool. If I get called away on this, I would get $68.73. That's a 13% improvement over where the market was when I sold this call. Once again, just like Cognizant, the actual market is better than my strike. So I'm not getting the max for my stock, but to me that's a lost opportunity. I'm not going to lose sleep over that. Let's look at our buy to close. Just like Cognizant, we'd be paying significant money for this. In this case, the the best seller was $4.40. So I collected $255 on the option. I would be spending almost $900 to close it with a net loss of about $640. Again, my recommendation on this would be I was happy to say I would sell my Whirlpool at $67.50. When it comes to the point of actually being called away, I need to let it go. So that's our 4 examples. We're going to go back to the PowerPoint, but before we do, any questions at this point, Lori, on the last 2?
Butch Lang was just wondering, he says that he thinks sometimes he'd rather go out to the 3rd or 4th month to find good APRs. Is there a reason that you tend to limit it to the 1st and 2nd months?
It's a great question, and we talk a little bit about that with the homework. You definitely get wonderful premiums the further out you go, but what I find is I would rather sell 1 month out and do it over and over again. So a lot of times when I have a stock that's close to a sell range, I might go 3, 4, 5, 6 months of collecting premiums month after month before I get called away and or before the price might pull back away from where I'm not going to sell calls. And I would rather have that steady stream of doing it month after month than putting on a 3 or 4 month option, which might actually take a long time for it to develop into a place where you can buy it back. And so I prefer the shorter term just because it feels to me like I get more opportunity to collect premiums on a regular basis. So for me, I prefer the shorter. So in the slides, in the handouts from the slides, I've got slides for each of the trades that I went through, just a recap of them so that you can play with it with the tool and do the same thing that I just did. But I just wanted to kind of recap the scenarios as well. So the first scenario, and that was our line, the current market was below strike. There was no advantage to buying it back, and what I considered a fairly low risk of exercise. So my recommendation in this scenario is just let the option expire worthless. The second scenario was Apple. The market price was still below the strike, but it was closer to the strike price, especially on a percentage basis. And I was able to find premiums where I could effectively buy to close at a price that felt good or felt right. I felt like Apple did have a high risk of exercise because Apple can move $10 easily on one day. So in this case, my recommendation would be to go ahead and buy to close. And of course, scenario 3, which was both Cognizant and Whirlpool, the market price was actually above the strike price. I would be losing money if I bought to close the option. I'm almost certain to be exercised, but my recommendation is let the option be exercised and let your stock be sold. So that's just kind of recapping the 3 things and what I would be doing in those scenarios. Quickly then, what I wanted to do is move to the homework assignment. We had some people that submitted their answers. I hope there's more people who did it than submitted answers, because I think the people, I know I've talked to some of the people that actually turned in their numbers, and I think it just working through the exercise improved their understanding of this significantly. So if you didn't do it, you could still do it for this next for the next month. I mean, the August calls on Disney are about ready to expire, but you could do it for September. And so just to recap, the assignment was you had 300 shares of Disney that were bought roughly a year ago at about $31. Assignment was to sell an out-of-the-money covered call and strive for the largest APR. Well, we had 3 submissions. Cool Contestant 1 had a 35% APR. 2 had a 39% APR, and 3 had a 22% APR. So obviously contestant number 2 gets the trophy this week. But I thought it'd be interesting to look at all 3. So Cool Contestant 1 on August 9th, that was, they were really gung-ho. They did it the day after Cool Club, and they did a $50 strike, which was just barely out of the money because Disney was at $49.97. Technically, that might be called at the money, but it is out of the money. It was an August 18th expiration, collected a 46-cent premium, and netted $123. APR 35%. The second contestant waited 4 days. Of course, 2 of those days were weekend. So one was done on Thursday, one was done on Monday. $50 strike again. Disney was actually a little bit lower, $49.71. An August 18th expiration, collected 30 cents, netted $75. But because there were fewer days left, the APR was actually higher. Contestant number 3 was a day later, same strike. Disney was about the same place as 2, August 18th, but now the premium has dropped to 17 cents, and that person only netted $36, and the APR was 22%. The thing that I want to stress here is, even though my exercise specifically said who can get the highest APR, I'm hoping the people who did it realize that there's more to this than just APR, because obviously this wasn't the highest APR, but netting $123 feels a whole lot better. So there is some combination of what am I making. And in this case, both of these 2 violated our rule of trying to get $100 on a trade. So now my commission is chewing up quite a bit of the gains that I made. For me, I'd probably rather do a 25% APR with 3 weeks to go than a 30% APR with 1 week to go. I'd rather collect the larger premium in that case, with the caveat that sometimes if it's a stock that does weeklies, then just like I was talking about before, I might go ahead and do the weekly because I know I'll get another opportunity to do another weekly for next week. So I'm talking about I guess it wouldn't be 1 and 3 weeks if I only did monthlies, but maybe it's 1 week and 4 weeks. Here were some of the comments from the contestants. One said that they didn't feel like Disney was a good candidate for covered calls at this time. I have to agree with that. When I gave the assignment, I was thinking maybe the Barron's article that was touting Disney as still a great buy might hype the stock price a little bit, but in reality it didn't budge the needle at all. They also said the APR was higher for the front month rather than the second month, even though the premium was less, so we just talked about that a little bit. And that's always going to be the case. The premiums are always going to be higher the further out you go, but the APRs sometimes tend to get accentuated up close just because there's so few days left. Someone else put their order in 6 cents above the best bid and had to wait a couple of hours for the order to fill. But no sooner had it filled, but the next trade was 2 cents higher. But that's the kind of games that'll happen, and you can't lose a lot of sleep about it. You have to just to decide what's a good place for you to sell and put your bid in and hope for the best. And then another contestant said, had I waited 1 more day, I could have gotten 2 cents more. So sometimes they do go up instead of down as the days get shorter. What I'd like to do this week's homework is, for those of you who did the first homework assignment, now your job is to decide how to close your Disney call. So now you have to decide whether you're going to let it expire worthless, whether you're going to buy it back, or if it moves above $50, which is the three that got submitted, are you going to allow your stock to be called away? And if so, how much are you going to make? I hope if you didn't do last week's, as I said, you take the challenge to do it, still do it, and do it maybe looking towards September expirations, and then after you've done it, you can go ahead and work the next homework assignment. You might not have it done for next week, but I think these homework assignments are great exercises for you to learn about selling covered options, and using the options or the virtual trading simulator, you get a real feel for how these things work. Let's see, questions at this point, Lori?
I don't see any questions, I guess, but if there's a few minutes, I was wondering if anybody had a stock they might be interested in seeing you work through in the Cool tool, even on the sell to open side tonight.
We can certainly do that. While we're waiting for that, next week's session, which will be 10 p.m. Eastern Time, will be a Cool tool for cash secured puts. And I don't know if it'll be the first one in September, but fairly quickly in September, then we'll do a Cool tool that's for broad market indexes.
Here, yeah, we're getting some stocks. One that came up last week, which you didn't have time to deal with, was Arena. Do you want to take a look at that one?
Okay, on the sell to open side, or
yeah.
we got one on there want to close?
He says sell to open. I guess he doesn't have a mic.
Okay, so Arena is ARNA, if I remember correctly. Okay, so if we bring up stock charts, it looks like we had been trading down on Arena, and then we got the good news, and we got a little bit of a pop. So when we think about our questions on our sell to open, has it gone up for a while? I'd have to say, I tend to say no, it's only been up for a short period. I mean, that's a debatable question. I guess we could say yes. Oops, let's go back and put our ticker in. So is it up on the day? No, it wasn't. Is the market up on the day? Today was kind of flatlined a bit. We could say yeah, slightly up. Let's say we have 100 shares. I don't know how many we're talking about. And I don't know what your specific sell price is. Does he have a target, Lori, that he's willing to share?
No. Don, do you have a target price that you would be happy selling? He says 11.
Okay, great. Let's put 11 in. Do I feel like the price will go down? Well, it kind of is softening right now today, so yeah, I do. Do we know when their next earnings are? Okay, so we can go to Yahoo Finance and put in Arena. And while we're on this page, we'll check to see if they pay dividends, and they don't, which is what I thought. But we can then look at company events. And November 8th is the next earnings announcement. So we can throw that in here. And no, they don't pay dividends. Okay, so now if we go, we want to look for strikes above $11. If we bring up our virtual trading system, and we say trade options, and we put Arena in, and say find chain. If we go to just calls, and at this point, because August is just about expired, I'd be probably looking at September. And so we quickly see that, oh, I'm sorry, yeah, for $11 strike, if that's the lowest, we'd get 22 cents. So we can go back to the tool, and we can say $11 strike, and our expiration is September 22nd, and we're going to get 22 cents. How many contracts? 1. And so our APR is pretty anemic, and we're not collecting much premium. Now, maybe if we had 1,000 shares, and we were talking 10 contracts, it would look better. So the reason that was so distorted was because with one contract, all of a sudden those commissions eat up most of that 22 cents. But the minute I start looking at more contracts, I might actually have a pretty decent proposition. So I have no idea what size your position is, and if you're looking at 100, I'd say I wouldn't be playing with options on it. If you have significantly more than that, then there might be some opportunities. Now, this brings up a good point. If you look at the minimum premiums up at the top, you'll see it says 32 cents. These minimum premiums are always assuming that you're only doing one contract. And so on a stock like this that gets heavily weighted, or the commissions start becoming a significant portion for one contract, these are going to be slightly off if you're looking at significantly more contracts. So if we went back to looking at only one contract, it says I need to be doing 32 cents. If I put in the 32 cents, then you see I do in fact get my 20% APR. Did that help?
Yes, you got to thank you for that. Kim Butcher was asking about BK, New York Bank of Mellon, but I did ask her if she felt the stock is a bit overextended at the moment, and she said no. So I'm not sure that that would be the scenario under which you would want to sell a covered call anyway.
Okay, so let's go here and look at our stock charts. So looks like BK has been running since kind of the last week in July, has been moving up kind of from the $20 range to maybe $22.50, maybe a 10% move. So if we go back, has BK gone up? Yeah, for a reasonable amount of time. Is it up today? No. Is the market up today? We'll barely call that yes. Again, I don't know how many shares we're talking about. Does she have a minimum sell price?
She says $24.
Okay, great. She said no on feel like the price will go down, so it's going to flag it and says you may want to wait until you are worried about it turning down. Our BK earnings date, we can go back to our Yahoo and throw in BK and first check our ex-div date, which is July 26th, but we're going to want to add 3 months to that. And then we go to our company events. And next earnings announcement is October 19th. So 10/19, and oops, we add 3 months to our div date, so that's going to be, can't type, October, oops, retry. I needed to say yes, it pays a dividend, and then put in the dividend date. So we need to look for strikes above $24. So let's go over to our trading system. Let's put in BK. And find chain. This is our BK chain. We can go to just calls. We might want to look at it September. And we see that the $24 strike has a pretty anemic um, bid of 6 cents, which, I mean, we can go through the process, but we're obviously way below the 61 cents suggested. So I would say at this particular junction, the BK doesn't look to have very attractive options without going any further. I mean, we could put it in. So 24, what expiration? We were looking at the September 22nd. What premium? 6 cents. How many contracts? And look at that. We didn't even collect enough money to cover our commission on the trade. Not too smart of a move. Again, leverage-wise, if we were talking a bigger position and talking 10 contracts, you at least clear positive money, but pretty anemic APR, as we might guess by being that low.
How about if you drop the price to 23? Does that give you any more choices?
We can look at that. So let's go back to our chain, and if we go to 23, oops, flip month on us again. If we go to the 23, now we're looking at 25 cents. So we go put our 23 in, same expiration, but we're looking 25 cents. So we're still about half of what I'd like to see on an APR. You're starting to get, I mean, it's reasonable money, but it's not a return that I would do. Again, you have to make your own judgments on what returns are acceptable for you, but I've found it works extremely well to be targeting for 20%. This is the kind of range I'd be looking to buy it back rather than to sell it.
How about if you go to October?
Okay, so if we go to, and actually BK, Mellon doesn't even have an October. They go straight to December then. There are no October or November. What that tells me is the market is not all that worried about Bank of New York moving away from current price in any kind of significant fashion. There's no greed factor where there's people betting that it's going to jump in price, and there's no fear factor that there's some news waiting out there and it's going to drop in price. And so when there is no fear and there is no greed, what you start seeing is pretty anemic premiums. But that just because that's true today on Bank of New York doesn't mean it will be true tomorrow or the next week, because there may be they may announce a new program where they think they're going to get significant improvements in their income, and all of a sudden people then are betting on how much that's really going to mean, and so now there's a greed factor on, well, where's the price going to go? Or there may be a negative news story, and that's what's going to drive put premiums up. But from time to time, almost all stocks reach periods where the market kind of says, it's about properly priced, and I don't think it's going anywhere very fast. But that doesn't mean that it'll stay that way always. We are sitting at almost an hour.
Yeah, Butch Lang has had his hand up for a while. Is it okay if I unmute him? Butch, are you still there?
I am.
Yeah, did you have a question?
I just want to thank Paul for all the tools here. I've traded these for many years here, and I find these tools to be very helpful. And I haven't done the homework, frankly, because I've been able to do some almost identical type trading in my own accounts with Aflac and FedEx for the August, and then also I've been trading in the one of the clubs that I'm in by trading BioReference and Quality Systems, for example, which some people are familiar with those two companies as well. So I've been very busy, Paul, since you started Cool Club, and I feel that I'm doing much better. At least I have a more educated approach to it, and a lot of the things I've been using in the past, for example, like identifying next earnings, quarterly earnings dates, ex-dividend dates, all of those things I've factored in the past as well. But the tools are great, and it's been very, very helpful to me personally, not only for my own accounts, but for the club's account.
Well, I appreciate all the kind words, and it's been fun doing it, and I've enjoyed all the positive response. That makes it easier to keep doing it. And these tools are new and aimed at kind of people just learning, but they were easy to do because they're modeled off of other tools that I've been using for the last 2 years. It's been fun to do, and I've enjoyed providing them. So we'll keep it going as long as there's interest and there's things to talk about and do.
Great. Thanks for all your effort.
Yep, I appreciate all the kind words, Butch. That's great. Well, very good. I think with that being a full hour, 30 minutes beyond what we were supposed to take, I think for tonight we'll call it a night. Look forward to seeing as many of you as can make it next week at 10 o'clock, and we'll be looking at the cash secured put cool tool. With that, thanks and good night.